In today's video, we are going to take a look at a case study. We've got an individual a little bit over the age of 40, and he's looking at a policy where he is going to fund $100 per month. He does have a lump sum that he just received, and he'd like to throw that into a policy. It's about $20,000. So really, he wants to see what the policy looks like if he starts out year one with $20,000. He moves that lump sum that he doesn't want to keep in cash because he's afraid he'll spend it. What's it look like if he moves it into the policy and then funds it just with $100 per month, along with some additional options? So we're going to look at one policy in this example with one company, but in addition to looking at the basic scenario. So when I say the basic scenario, his primary point of interest, which is $1,200 per year or $100 per month, we're going to look at funding up until about age 65 in this example. So show me that first, along with the 20K lump sum. But then what does it look like if I add more money? So we're going to look at a couple different scenarios there. We're going to look at one scenario where he pays $5,000 per year, and then another where he pays $10,000 per year, but all the same policy, so we can pivot and adjust the actual funding amount, funding period, as the years pass. He is interested in the cash value. This is, like most people we work with, his main focus. However, the death benefit is important to him as well. He's got 3 kids. A lot of people we work with will state to us, typically over the first call, I don't really care about the death benefit. Or the death benefit I see on this illustration is plenty, that's high enough. I'm really interested in the cash value. And that death benefit usually does become more and more important as the years pass. However, this case is a little bit different where he does have a need for the life insurance and it is important to him. Now, a couple things here. Number one, he does not want a high bill. So we mentioned up here, his bill or the actual premium amount he's going to be paying to the policy each year will be $100 per month. So each year, $1,200 per year. He does not want to be committed to $20,000 or any large amount of money. He's got a lot going on with his business, 3 kids. Like he said, keep it low. This way it never feels like a burden. And another thing is, he does not want to have to make payments forever. A lot of people we work with fall under that umbrella, not having to make payments into a policy forever. So when we look at the actual design of the policy, how it is set up is as follows. We've got a premium, which is the underlying base premium of $1,200 per year. It's actually a bit lower than that. I'm going to pull up the illustration shortly. But premium dollars, with respect to one's cash value, which is the point of interest, what are the core benefits to a cash value life insurance policy? Safe, liquid, tax-free. Tax-free if we don't trigger a modified endowment contract or other taxable event. But premium dollars, in the first year, we don't see anything show up in cash value, or a small percentage of the premium show up in cash value. And the reason why is because the life insurance company is going to overcharge us for the death benefit up front. Then he's got a PUA rider here, which stands for paid up additions. So in purple, I'm just going to put this in blue. This PUA component does build cash value right out of the gates. This is the key to accelerating the cash value of any whole life insurance policy. This is money he does have access to. It begins to earn the guaranteed rate, begins earning dividends. When you look at high cash value life insurance policies, this rider is attached every single time, specifically with whole life insurance products. Now, we've got the word optional here. What is optional is 1, if he decides to add money at all toward this rider, and 2, how much he adds to this rider. In the first year, you're going to see a large PUA payment to make his total payment $20,000, but he does not have to add money to this rider each year. The specific company we're going to look at in this example is Guardian Life Insurance, which they have a very, very flexible PUA rider where we can just throw money into PUAs anytime we want. And if we've got a 1-year term rider attached, I'm going to highlight that in the illustration. We can illustrate up to 10 times the base premium in annual PUAs. The MEC limit. Remember the 3 core benefits we mentioned about cash value life insurance? Safe, liquid, and tax-free. So any life insurance policy, or I should say a big point of attraction to whole life insurance products, is that the cash value can be accessed tax-free. Now, there are events that can occur that can result in us having to pay ordinary income tax on the gains of a cash value life insurance policy. But if we do everything right, we can access that cash value tax-free. This is why a lot of people are attracted to it. Now, this MEC, it stands for Modified Endowment Contract. Any life insurance policy can become classified as this modified endowment contract. And if it does, in short, the cash value grows tax deferred, and anything I access with respect to the gains, I have to pay ordinary income tax and a potential 10% penalty tax if I'm under the age of 59 and a half. I don't want a MEC to occur. It ruins everything. So how we prevent it is like this. Every policy has what is referred to as a MEC limit, which is exactly what it sounds like. It's a limit that the IRS determines, and it's the maximum dollar amount you can pay into a policy per year and still have the IRS view your life insurance policy as life insurance, therefore reap the tax benefits cash value life insurance has, and not a modified endowment contract, a taxable event. So MEC limit we set at $20,000. How we set the MEC limit is you'll see what the MEC limit has a direct relationship to is an individual's age and total death benefit. For a 41-year-old individual with the product we ran, he needs almost exactly $400,000 in total death benefit in order to attain that $20,000 MEC limit. We rounded up a little bit just to get a clean death benefit there. But we want the minimum amount of life insurance in order to achieve that $20,000 MEC limit. Then the funding. So what we're going to look at in the first year, we will see $20,000 paid into the policy. That's just total out of pocket in the first year. So one thing I'll add, just a point of clarification, we've got $1,200 per year or $100 per month, and then a $20K lump sum. The first year, he wants his lump sum payment to cover his annual premium. So he doesn't want to pay $100 per month plus $20K on top of it. He wants the $20K to cover everything in the first year. So his net out of pocket is the lump sum that he received. And then beginning the second year, years 2 onward, set it up where I'm only committed to $1,200 per year. So, along with the option to add more. Almost forgot one of the most fun parts. So now let's take a look at the illustrations to start, and then we'll look at the what-if scenarios as we build on top of it. So we've got a Guardian L95 product. As we take a look at this guy, here's the most important piece. Where is your money going? So if this is you and you receive one of these illustrations with any life insurance company, it can be overwhelming. A lot of information going on, and this is page 14, right? So what's on all of the other pages? Where's your money going? Here's a clean breakdown. So when you pay any dollar amount into a life insurance policy, you, the policyholder, can decide where your money goes. Here's the premium, $950. Now we mentioned it was $100 per month, which is $1,200 per year. We did set it at that. Here's how we did it. We've got $950. That buys him a whole life death benefit of about $43,000. We've got this guy attached here, this $350,000, which is term insurance. I'm not going to go through every detail in this video. There's a cost to that term insurance rider, which is down here, another $177, just approximately, for the first year in actual term insurance costs or expenses. So in summary, what we did here, $950 is the true minimum premium. Then here, look at this. You've got a scheduled PUA rider. So we scheduled another $250. So meaning when I say scheduled, it is billed at the same time that his minimum premium of $950 per year. Add those two numbers together and what do you get? $1,200 per year. Now what I'll add about this $250 right here, this amount does cover the term insurance cost. And then everything else above it is plowed right into PUAs, which accelerates my cash value growth. So where's the money going? Premium, $950. Term rider, $177. Everything else toward PUAs. First year lump sum, $18,800 into a PUA payment. Total out of pocket, $20K in the first year. Let's scroll down. So what do we see here? He pays in the first year $20,000. If this is you, this is the total dollar amount you paid into the policy. And in the first year, what do you notice here? Net cash value. This is the cash surrender value, what he has access to, if he cashed it out, what he would receive, just about $17,500. Now the PUA payment was $18,800. There are PUA fees that are associated with whole life insurance products. We've got some material on that. Reach out to us if you'd like to see some videos. It is reserved for those that are working with us, but if you reach out, we can certainly discuss sharing some of that content with you. If you work with us, let us know and we will send it to you. But there are PUA fees, which you'll see impact the policy more than any other years in the first year before any compounding has taken place, being the guaranteed rate and dividends. And then here's your net death benefit, which is the total dollar amount that's paid out if he were to die. Now, you will see a term rider attached here as well that gradually decreases. And in this example, we chopped it off altogether after the first 7 years. So when we look at this example, how long are we paying into the policy? Through age 65. Now, before I just jump to age 65, let's look at something important because I don't want to skip over some of the most important years, which are the early years. This is what everyone pays attention to. $20,000 in the first year, got about $17,500, $17,400 really. That's the worst part of a whole life insurance policy, the first year hit. Next year, I pay $1,200. Rose from $17,400 to $19,250. Did you get the full $1,200 back? The answer is yes. You got it back and a little bit more on top of it. When we pull this up on Excel, we're going to break down the year-over-year cash value growth. So by year 2, I'm getting my payment back and a little bit more. This column here, cumulative net AT, stands for after-tax outlay, tallies up your total payments. And you'll see here, between years 6 and 7, just about there, year 6, you paid in $26K and you got $25,900. Granted, this is just the minimum beginning the second year, a little bit more than the minimum, but a nice lump sum up front and then just the minimum. And then we continue to fund it through age 65 and then stopped altogether. He's got about $87,000 in cash value. But what about the what-if scenarios? So we've got the illustrations up here, but let's look at the actual Excel comparison sheet. This will make life much easier. So what we've got here is what we just looked at. Here's my minimum premium, $1,200 per year. Here's your PUA payment of $18,800, first year $20,000. There's your cash value. All of these values are pulled directly from the life insurance illustration. And what is highlighted in yellow is your break-even point. Break-even meaning when you have more money in cash value than what you've paid into the product. So let's take a look at this first. Cash value growth. This will isolate how much your policy is actually growing by net each year. So again, worst part of a policy is what? First year, $20K in, total annual outlays, the total out-of-pocket in your end. You have $17,447 in cash value, which means no matter how I spin this, you took a loss of $2,500 if this is you. Year 2, you pay in $1,200. Cash value grew from $17,447 to $19,250. We see cash value growth of $603. What this means is you got your $1,200 payment back plus another $600, $603 to be precise. And that is a combination of the guaranteed interest and also dividends that are being paid to the policy now. Then I see as I continue to pay, compounding kicks in, and it picks up the pace. How a lot of people view these products is really, call it a high yield savings asset. If a policy is set up properly, we've seen a lot of historical data where the net internal rate of return has produced between 3 to 5%. It's almost like a high yield savings asset. By the way, it's tax-free if I don't trigger a taxable event, that when I look at the loan feature, I can access it like a personal line of credit. Remember, when I borrow against a policy, I still continue to earn compounding on my entire cash value. We do want to account for the loan interest and see, am I paying more in loan interest than what my policy is actually growing by? All of those important things too. Let's look at the next example. So what if I add some more money to the policy? So year one, we've got the same $20,000 and then $5,000 per year thereafter. What does this look like? So first year will be identical. 20,000 in, there's the cash value. However, beginning year two, what we're modeling here is the same minimum premium. So if he pays that $1,200 per year, $100 per month, he can choose to do it however he wants. If he pays it monthly, there is a small fee, and that's the case with most life insurance companies. But here, we're assuming that he's paying the $1,200 premium plus another $3,800 in PUAs, which he can add that 100% at leisure. So he owns his own business. If he has some additional funds and he says, hey, what do I do with this money? Can I just throw it into the policy? The answer is yes. How we would do that with this particular company, he would just log on his online portal or his mobile app and throw the money right into PUAs, accelerating the cash value growth. What this does, by adding more money, we see that it does accelerate the break-even point with just the minimum. His break-even point was between years 6 and 7. Over here, now it's between years 5 and 6. We see the cash value growth looks stronger, but that is because he's dumped more money into the policy. So the compounding is a larger dollar amount because I've got more money in the policy. That's why. So now I'm compounding on a bigger bucket of money. Also, funding it through age 65, he's now paid in a total of $140,000. For this example, the first one he paid in a little under 50. Let's take a look at the last what if scenario we've got here. So in this what if scenario, what do we see? What if he throws in more money and funds it for a shorter period of time? So first year, lump sum of $20,000, likely won't get that into the policy again. Total of $20,000. However, beginning year two, same minimum, throws in another $8,800 though, total of $10,000. So what does it look like if he pays in $10,000 per year, but stops now at age 50? What does that look like? So he's got a total of $110,000 paid into the policy. Look at the break-even point. This is the strongest. Clean year 5. He's paid in $60,000, and he has $60,000. Death benefit still at $400,000. Cash value growth, picking up the pace year 2. What you'll notice here, the examples where he paid in more, you'll see the year 2 cash value growth is a little bit weaker. And the reason why has to do with that PUA fee. So the higher PUA fee does drag down the actual net growth in year 2. But what ends up being the result is you do get stronger overall cash value growth beginning year 3 and so on and so on. You'll see stronger compounding. So adding more money into PUAs when I've got a product with a higher PUA rider fee, the immediate impact is it will be negative. I'll say, oh, did this really make sense? But long term, I will see much more money. And long term, typically the year following, I actually make that PUA payment because then dividends are applied and it gets better and better. So here, nice break even. And then we stopped funding altogether after the 10th year. Paid in 0, 110 total. Cash value continues to grow. And check this out. So here, we paid in 110. This example, we paid in 140. At age 65, which one has more money? Same company, same product. I got money in faster, therefore it began to compound faster. And the nice thing about this is he does not need to choose which option he wants to go with when he first starts the policy. He's got the option to adjust as the years pass. Maybe he does this for a couple years, then 1 year he throws in a total of 5, then 10, maybe it's another 20 down the road. He can adjust his payments as the years pass, which is really nice just when we demonstrate the flexibility there. So I hope you enjoyed this video. If you did, please hit the like button, subscribe for more. If you have any questions, please leave them in the comments below or reach out to us direct. And thanks for watching. As always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.